So I think structurally the market has changed. That being said, I do think there will be drawdowns. I mean, all commodities have drawdowns. And then again, it's because price discovery is the most natural thing that the market should support for, both when there's demand, but also when there's supply in ways that there's more sellers than buyers. But what's unique about Bitcoin is we know for certain there's at least no new supply that is coming online that isn't coming from the secondary market, at least at the pace in which historically it existed. Bitcoin's back above 112K, and it's in matters of now days in which these 1,000 point swings are happening to the upside. And so there's definitely a bid. I think the bid's only going to get stronger. And as we know, Bitcoin is a bit of a momentum asset. When Bitcoin goes up, there actually tends to be more interest in people wanting to not feel like they're missing out.
The idea that Bitcoin is a bubble, a macro strategist Jeff Park contends, completely misunderstands its purpose. In a world built on fiat money and credit expansion, he sees Bitcoin not as the excess but as the pin that pricks the real bubble, the global financial system itself. Its emergence represents a fundamental rethinking of money, decentralized, permissionless, and resistant to manipulation. To Park, Bitcoin isn't inflating a speculative mania, it's exposing the flaws of the monetary architecture that has defined modern finance for decades. Jeff Park further explained that the emergence of Bitcoin ETFs has introduced a new structural dynamic to the market, providing an institutional safety net that reduces volatility and broadens accessibility. He noted that this innovation allows retirement accounts, wealth managers, and institutional investors to participate in Bitcoin through regulated channels, creating a persistent underlying bid. For the first time, there is systemic capital formation supporting Bitcoin at scale. Park emphasized that this institutional demand, combined with limit orders set by long-term investors, gives Bitcoin a stability that was absent in previous cycles, effectively reshaping its price behavior and diminishing the relevance of the old 4-year halving narrative. Jeff Park expressed strong confidence in Bitcoin's long-term upward trajectory, highlighting the momentum-driven psychology of the market. As prices rise, new investors are drawn in by fear of missing out, reinforcing demand and pushing valuations higher. Conversely, many of these participants are risk-averse holders, reluctant to sell during downturns, which steadily increases the overall cost basis of the network and strengthens long-term price floors. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the broader financial landscape. Thanks for watching.
I keep hearing people saying Bitcoin's a bubble and that we're near the end of the 4-year cycle and therefore we need to be tactical about asset allocation. And every time people bring up that point, I can't understand it. And I thought long and hard, like, why is there such a gap between our understanding? And I think it's because of exactly what I tweeted. How could Bitcoin possibly be in a bubble if it's the very pin that I think is actually unleashing the bubble itself, which is the entire economy based off of fiat? Mm-hmm. And then someone said, if Bitcoin's the pin, then what is gold? Isn't gold the pin? And I thought about that too. And I think actually the analogy there is gold is maybe the air that you're putting into the bubble as well. Because the entire fiat economy, I think, is ultimately based off of the foundation of gold as well being the store of value. So the bubble in the stock market and gold actually have a pretty meaningful relationship because gold is not in itself a useful network. I do think of Bitcoin ultimately as the definitive pin because it is just unwinding all of that inertia into thinking about money very differently, which is that money should be not permissioned. It should also be freely movable. And there's something about money velocity that changes with Bitcoin that is just not related to even the way gold exists in the physical world. I think also in the conversations, we often hear about the regulatory concerns about Bitcoin, not just being the store of value in itself, but also the speed in which transactions can happen being a systemic risk to the financial stability and how we need circuit breakers as a result. Because I mean, part of the entire world that we live in have these circuit breakers because we don't want money to actually move that fast. Because if money moves too fast, it actually changes the foundation of the idea of credit, right? Credit can only exist if money is actually dormant at some level. And that's why asset liability matching is the ultimate puzzle that everyone is involved in figuring that unlock. And Bitcoin, it just moves and there is no queue. There is no unlock. It actually is money in motion. And if that's what Bitcoin represents, then to me, that's the pin. everything that we've ever known about the construct of money and store of value is changing with Bitcoin. I think muted downsides is probably the right approach, mostly because there is a strong institutional bid on the back end. The ETF as a capital formation technique is novel for Bitcoin and that we haven't had historically before. And I don't think we should discount how important that institutional floor and bid is. The idea that all our retirement accounts, for example, can own Bitcoin at an attractive price. And there could be folks out there who are still waiting on the sideline and they're willing to put in limit orders on their retirement accounts, their IRAs, to say, hey, I'll buy Bitcoin when it hits 70K, 80K, whatever that number may be for them to feel that threshold gives them comfort. That institutional and retail bid just never existed before the ETF wrapper. So I think structurally the market has changed. That being said, I do think there will be drawdowns. I mean, all commodities have drawdowns. And again, it's because price discovery is the most natural thing that the market should support for, both when there's demand, but also when there's supply in ways that there's more sellers than buyers. But what's unique about Bitcoin is we know for certain there's at least no new supply that is coming online that isn't coming from the secondary market, at least at the pace in which historically it existed. So part of why I think the 4-year cycle too is something to be dismissed is because historically it's absolutely true that there was new issuance of Bitcoin in the past that was hitting the market that isn't coming from the secondary buyers and sellers. I think it will, because ultimately there are people who just want to build these positions and haven't been actively doing it because they are waiting for the right entry point. We used to have these conversations at my prior firm with Bitwise all the time. There would be investors who are, one, convinced of Bitcoin, they now understand it, but they look at the price and they say, it's actually just too high. I don't want to buy it at this point. I'll wait for a better entry. You'd be surprised how many folks think that this tactical kind of alpha generation by waiting would be to their advantage when most often they're not. Mm-hmm. And so there are investors who are just waiting on the sideline. And as you pointed out, what's been really nice to see over the last 3 months is every one of these Bitcoin, drawdowns, if you will, have been quickly bid up. I mean, even today, as we're talking, Bitcoin's back above 112K. And it's in matters of now days in which these 1,000 point swings are happening to the upside. And so there's definitely a bid. I think the bid's only going to get stronger. And as we know, Bitcoin is a bit of a momentum asset. When Bitcoin goes up, there actually tends to be more interest in people wanting to not feel like they're missing out. And that cascading effect ultimately draws more people in. But these same investors are actually pretty risk averse and they will not sell on the way down. And so what you end up happening over these cycles is you slowly move up the cost basis of the total network over time. Mm-hmm. And that creates these new floors. And so it is cyclical. But what you want is you want more money coming in at higher prices over a long period of time. And those trends have been intact now for quite a many years.
Jeff Park drew a sharp distinction between gold and Bitcoin, describing the latter as the faster horse in the race for value preservation. While gold may experience rare years of strong performance to offset decades of stagnation, Bitcoin's digital nature allows similar moves to unfold in a fraction of the time. Park argued that Bitcoin's purely digital infrastructure frees it from the physical constraints that slow traditional commodities. There's no need for storage, shipping, or clearing mechanisms. This freedom makes Bitcoin far more responsive to changes in investor sentiment and liquidity conditions, allowing capital to move instantly across borders and markets. He emphasized that this frictionless efficiency is what gives Bitcoin its edge as a store of value in the modern economy. Unlike gold, which operates within the limits of traditional financial infrastructure, Bitcoin's decentralized network enables seamless participation and real-time price discovery. In Park's view, the absence of circuit breakers and logistical bottlenecks means Bitcoin can compress years of gold-like revaluation into days, making it not just a faster hedge, but a technologically superior form of monetary asset for a digitized financial era. Let's get back to the interview.
If gold can catch up for all its underperformance for decades by having an outperforming year like this one, Bitcoin's timeline is just compressed. Mm-hmm. It won't take a year. It'll just happen in weeks, maybe even days. And that's why I think Peter's not wrong. It's just Bitcoin's the faster horse. Mm-hmm. Mm-hmm. And part of why Bitcoin is the faster horse is because it doesn't have the same circuit breakers that the market structure of a physical commodity does. Mm-hmm. Anyone can buy at the moment that they choose on code. And there is no logistics, there's no warehousing, there's no seeking of supply. There's no futures that you otherwise have to allocate for. It's literally just something you can go on Coinbase or wherever and hit the buy button. There's a quantitative one and there's a qualitative one. The quantitative one is pretty intuitive, which is that in the ETF wrapper, you have basically the ability to participate in the traditional capital markets that the spot market in crypto has not been developed yet enough to the level of same professional standards. So lending Bitcoin to earn yield has been a very popular and well-tried strategy. We all, of course, know the downfalls of what that can mean in the crypto spot market, especially when you're an unsecured lender. But within the ETF world, because you're playing within the securities framework of actually having a central clearing business, there being a short desk and a borrow desk and buyers and sellers matched in that framework, you're not really taking counterparty risk, right? You're actually just taking the risk of the issuer, which has been vetted at the highest level and at their custodial practices. And you're not actually involved in like rehypothecating the underneath asset. So if you ever wanted to earn yield on your Bitcoin and do it in a safer way, it just might be safer to do it in the ETF format and actually borrow your shares of the securities rather than the spot asset itself. It's one of the reasons why a lot of the large crypto hedge funds have actually chosen to take their Bitcoin exposure in the ETF wrapper than the spot wrapper. Mm-hmm. The other real benefit too that is less talked about is now you can actually cross-margin that Bitcoin ETF with your non-crypto assets. So if you own Bitcoin in your Coinbase account, that's great, but you're not going to get margin on that position to then go out and buy Microsoft and Apple. Mm-hmm. But if you were to find a multi-asset prime brokerage model in which the custodians can actually underwrite that risk and give you some of the margin benefits, then you found funding liquidity. And that's a great unlock for somebody who might be sitting on a lot of Bitcoin. And now you can actually find ways to bring leverage into that in the ways that you deem. That's some of the quantitative benefits and features that I think is worthwhile. The qualitative benefit is actually going back to the RIA business itself. RIAs are compensated at some level by providing financial advice to their clients for which their net worth is measured by the assets they bring to the table. It's very challenging for financial advisors to be able to have ownership of your client's Bitcoin assets if it's not part of that conduit in the way that it's meant to speak. So you might have $1 million in stocks and you might have $100 million in Bitcoin, and your FA is not going to give you the treatment you deserve for actually being a super ultra high net worth because he doesn't know how to think about that $100 million of Bitcoin. If you contribute that now into an ETF format and your account value goes up in a way that these financial advisors were not able to recognize, you're now a VIP. That qualitative element can't be underestimated. I think most Bitcoin investors that are super wealthy out there are just not being treated fairly in the same way that they could access credit and financial services otherwise. So that's a really meaningful additional feature for crypto investors.
Bitcoin represents a structural shift in how value and money are understood, functioning not as a speculative bubble but as the force exposing the fragility of the fiat-based financial system. The introduction of ETFs has transformed its market foundation, created a strong institutional bid and embedding Bitcoin into mainstream investment channels such as retirement and brokerage accounts. With predictable supply, diminishing issuance pressures, and expanding institutional participation, the traditional four-year cycle narrative is losing relevance. Its digital design, free from physical and logistical constraints, gives it the agility to achieve in days what assets like gold might take years to realize. The ETF framework further enhances Bitcoin's position by offering safer yield mechanisms, cross-margining with traditional assets, and granting crypto investors recognition within established financial systems. Altogether, these developments mark Bitcoin's evolution from a disruptive experiment into a mature, integrated, and increasingly indispensable component of global finance. How might the growing integration of Bitcoin into traditional financial systems through ETFs affect its long-term volatility and role as a global reserve asset? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and we hope you enjoy the video.